everybody. Welcome to Everything Accounting. I'm Alfred, your friendly neighborhood CPA. I'm here to talk you through today about your financial statements and kind of give you some insight of what to know when looking at your financial statements. In this video, we'll talk about obviously the balance sheet, the profit and loss sheet or income statement, and the cash flow statement, and kind of how they all intertwine together, because that's probably the most important thing when you're trying to analyze your business's success. So we'll start off, I think the most important one is the profit and loss sheet. That's essentially to show you how much profit you've made in the year or in the time period that you're looking at. A profit and loss sheet is different than the balance sheet and cash flow statement, solely in the fact that you look at it in a section of time. So if you want to look at it for the month, this is, say you're in January, you want to see how you start off the year, then you go January 1st to January 31st, it'll only show you that segment of the year. Or you can do the entire year or the quarter or what have you. But essentially it's showing you at a specific moment in time how much revenue you've made, how much expenses you've incurred, and what your net income is for that year. So one thing to mention is that the net income is not equal to cash. I'm telling you, hundreds of clients be like, well, I don't see that balance in my bank account, or why do I not have that much cash, or whoa, that's a lot more than I expected. It's very different than what your cash balance is. It's very different than anything of that nature, solely because as we walk through the cash flow statement, as we walk through the balance sheet, you'll see why your net income at any given period, especially at the end of the year, is not always going to be equal to the cash that you have on hand or the bank balances that you have. But it does give you a snapshot of how well you did in the year. So when we're looking at your income statement, there's three main sections that you're going to be looking at. You're going to have your revenue, which is your sales, your expenses, which is all your write-offs, all the things that you've incurred over the year or over the period, and your net income. Now, your sales, you want to break that out based on all the product mixes that you have. So if you're selling a lot of products and you have product A, B, C, D, or E, you can either have all of them combined into just one line item sales, or you can break them out per product line. I actually suggest to a lot of my clients to break it out per product line so that you can track year over year or period over period how well you're doing in terms of your sales flow, right, for those items, because sometimes some of your products become redundant. So people aren't going to be buying it as much. So you start to see the changes over the periods. So that's why I always suggest to do it segmented out in that way. But that essentially is your sales. That is the dollars coming into your business over that period. Then you have your expenses. Your expenses can be split up typically into three sections. You have your cost of goods sold, or your cost of service, you have your cost of labor, and then you have your general and administrative expenses. Your cost of goods sold and your cost of labor are two direct costs. So what that means is for every dollar that you bring in, you have to incur these expenses to bring in that dollar. So cost of goods sold or cost of service is essentially, if I'm, as an accountant, if I'm providing a service and I need an accounting software for that client to then run, that accounting software would be a cost of service for me. Or if you are in construction and you're building a home and you've invoiced, the lumber that you bought is the materials, which is essentially the cost of goods sold that you would incur for that job. So it's directly related to the sales that you bring in. Cost of labor is the exact same thing in that sense, is that if I, as an accountant, I'll always fall back, just an FYI, I'll always fall back to like my experiences when it comes to things like this, because I find that it's a little bit more relatable in that sense, and you kind of get a sense of what I do typically. As an accountant, if I'm putting in, say, 50 hours this week for this client, those 50 hours are a cost of labor to incur that level of sales. So that is kind of how I trigger it. Just like if you're on a job site for the construction company that we were talking about, them hammering nails into the wall or putting up drywall or whatever it is, that labor that is directly related to making the sale of the construction job, right? So anything of that nature, anything that's directly related would fall under those two categories typically. Then you have your general and administrative expenses. This is essentially your overhead. A lot of these expenses are very fixed month over month, or are not directly related to the job, but could fluctuate mildly depending on usage. So with general and administrative expenses, you tend to have office supplies. Office supplies could be pens, paper, ink, erasers, even a calculator. These are all things that, and I know no one uses a calculator. I get it. I do. But, but any of these expenses could be incurred as office expenses. So they could fluctuate period over period, but they're not directly attributed to the job. Another one that comes up is payroll. So we talked about cost of labor for direct costs, but then you have indirect costs. So if you have administrative assistants, if you have specific employees that are running your business, HR employees for non-HR businesses, for me, for instance, I have employees that work with me, and those employees are 100% just a payroll expense to me. So with payroll expenses, you have obviously administrative staff. You have employees that work day in, day out, whether your sales increase or not. So those are the types of payroll expenses that will go through. So on top of that, you have your CPP, your EI, your income tax, all these things that are being incurred. You'll also have random expenses that come up like travel. Travel is the best one because everyone asks me, can I expense travel? Can I expense this? What about my car? All these things are expensable as long as they're related to the business. And we'll talk about that in another video. When we're talking about expenses, these are just specifically, especially G&A expenses or general and administrative expenses. These are your expenses that are overhead to just running your business. Then at the end of the day, you have your net income. So the basic calculation with it is your sales minus your cost of goods sold, your cost of labor, your direct costs, minus your G&A expenses gets you your net income. Net income is essentially how profitable were you this year? Did you make money? Did you lose money? Did you break even? How did you do? A lot of people tend to just jump into the net income and only look at their net income, which is fine, but it's also really important to year over year or period over period, look at how your sales grew or declined, how your expenses grew or declined, and what caused that impact in your net income. Because you could have had the exact same amount of sales, but if you started tweaking your expenses a little bit to be a little bit more efficient, then you could probably make more profit. Or the other way around, say your expenses went up because just costs in general went up, then your profitability went down, but your sales stayed the same. So it's always good to evaluate all three on the net income side. Now, your net income will flow into your retained earnings or your owner's equity onto the balance sheet, which essentially lasts year over year. But your net income at the end of your fiscal year, which is basically when you claim as your year end for your business, most people have it as calendar, but you can, if you're incorporated, it'll really depend on when you choose your year end to be. But at that period, your income statement gets diluted into your net income, and your net income flows into your retained earnings onto your balance sheet. And then you start over again in the new year. So next we'll talk about the balance sheet. The balance sheet is actually broken up into three sections as well. You have your assets, your liabilities, or your equity. So owner's equity and retained earnings. And like we were talking about before, the retained earnings is your net income compiled. So I'll start with the retained earnings just for continuity purposes here, but retained earnings essentially is your year over year profitability. So it's basically showing the health of your business over its lifetime. The balance sheet as a whole is tracking from the start of your business to the day that you're looking at the documents and looking at your balance sheet, what you've actually incurred or what you've grown. So if your assets have gone up, if your liabilities have gone up, if your equity has gone up, all these things is the lifetime of your business that we're tracking on your balance sheet. So unlike the net income that goes from period to period, the balance sheet is from the beginning to the end of your business. Talking about assets, your assets are basically anything that you have of value within your business. So current assets and long-term assets is typically how they split up your assets. Current assets being anything that is usable or convertible into cash, and to be liquid is what accountants call it, but can be converted into cash fairly easily. Current assets would be your cash, your bank balances, your accounts receivable, which is what people owe you, and inventory. And then anything short-term that you might hold in that nature. Long-term assets are your property, plant, and equipment. That's what we call your buildings, your land, your furniture and fixtures, your leasehold improvements. Say you had to renovate your office space. That's called leasehold improvements, and those are things that we count as assets, right? And then all your long-term assets can be depreciable, which is essentially you depreciate those assets over the lifespan of those assets. So if we believe, say, cars as an example, they typically last, in the eyes of the government, like 5 to 6 years. So if you claim that 20% of the value of the car gets depreciated year over year, so the value starts to decrease year over year, but you also have to track that on your income statement as well as your balance sheet. So it kind of balances out as a whole. So long-term assets, as long as the value doesn't drop, it basically will hold on your balance sheet for an eternity. Next, you have your liabilities. Your liabilities are also broken out into current liabilities and long-term liabilities, but your liabilities are basically what you owe. So looking at any debts, any credit cards, any lines of credit, any accounts payable. So say you have suppliers that you have to pay. Anything of that nature where you owe money lives on the liability side. After your current liabilities, you have your non-current liabilities. So these are massive or bigger balances that you owe. So long-term bank loans, if you have mortgages, if you have long-term lines of credit. So your line of credit also could have a current portion to it and a long-term portion to it, right? So those can be split up as well. So essentially your liabilities at the end of the day is what you owe as a whole for the business at that certain point in time. Next is your equity. Your equity is what you've actually made within the business and the value that you've created using your assets and using your time and everything, and evaluating how much the business is actually worth. So your equity at the end of the day, like we said, is your net income flowing into your business plus your initial investment. Most people, let's say, put in $100 to start off their business. That's their common shares or their opening equity. As you build on that, your initial investment of $100 is added to the equity that you're building up year over year, and that gets you to your current value of your business. I know it's really technical, but that's essentially what we're looking at with all this stuff. The way that it's calculated, if we ever want to calculate out what we're looking at, is assets equals liabilities plus owner's equity. That is always how you balance the balance sheet. Get it? So you always want to make sure that your assets equals your liabilities plus your owner's equity. Things to look out for when you're looking on your balance sheet is, are your liabilities more than your assets? Because that's something that banks will look at, that the government will look at, that investors will look at. And anyone that is interested in your business will want to know, if things go south, can you cover your liabilities with your assets? And then they also want to see your year over year equity. So as you've built over the business, are you break even every year? Are you growing slowly? Have you lost over the last 10 years? They just want to know how successful the business is, and they usually use the equity side of the balance sheet to see the overall success of the business. Now, there's obviously a lot of factors that come into play there, and it's a lot more intricate than that. But generally speaking, when you're looking at your balance sheet, those are the three things that you want to really evaluate. Next, and this is why it's really important to evaluate cash, because cash is all that anyone really cares about at the end of the day. So we jump into the cash flow statement. And the cash flow statement is evaluating basically all the activity that's going on in your business during a time frame, how much cash you brought into your business during that time. So when we look at it, you start off with your net income, and then you'll add and deduct different aspects of the business. So your accounts receivable will probably deduct the amount of cash that you have. Your accounts payable will increase the amount of cash that you have. And the reason for that is accounts receivable is cash that would be essentially paid to you, but people owe you money, right? Your accounts payable is what you owe other people. So you're holding more cash than you actually owe on that line. So it kind of nets out on that end. And then if you bought inventory, that would be an impact to your cash flow. If you bought an asset, a long-term asset, that would impact your cash flow as well. And all these things, it kind of makes sense when you look at it, but all these things kind of outline and break down how much cash you should have at the end of that period. So whether it's a positive impact, a negative impact, this kind of gives you insight into why your cash balance or your bank balance is not 100% equal to your net income. If you invoice, let's say, $100,000, and then your net income was $50,000 on that, if you don't see $50,000 in your account at that time, in addition, then it's most likely because you have increased AR, or you paid out expenses previously, you bought different assets, or you paid down other debts, or what have you. All these things obviously lay out and impact why the $50,000 of net income is not in your bank. So that's kind of how you want to outline it and make sure that all these things flow through, so you understand, not only do you understand your profitability from your net income, but you also understand where your assets are, what your liability and debts are, what your equity is, and then how much cash you're bringing in period over period. So all these things kind of lay in together, and that's why it's really, really, really important to not just look at one financial statement and look at all three financial statements together to see the success and the health of your business. So that in a nutshell, and a long-winded way, is your financial statements as an overview. So you have your balance sheet, your income statement or profit and loss sheet, and your cash flow statement. So that is hopefully giving you a little bit of insight into your financial statements, and hopefully it'll help you analyze your financial statements a little bit more and get a little bit more insight from your business and understand the health of your business. Anyways, it's been Alfred, your friendly neighborhood CPA, and this has been Everything Accounting, and wish you guys all the best. Have a great week.